Give me a second. Okay, yeah, you can go for it.
All right. I'm glad to be joined here by Marko Papic from BCA Research, geopolitical strategist. I can't think of a more interesting guest to have online for this market environment because geopolitics is actually driving everything right now, and there's just so much that I want to talk to you about. What we'll do, by the way, those of you just logging in. Please start typing in your questions. We'll get to them. We're gonna lots of stuff to chat about. We'll get to all of your questions in there. So get that typed in. So Marko, let's have a chat here about a big picture thing, because I saw a recent headline about UK Prime Minister Starmer basically stating that globalization has failed as an economic model, and its time is now at an end. And to me, globalization was anchored on the US dollar. And so if the Triffin paradox requires the US to run these huge trade deficits to supply the world with these dollars, do Trump's policies, which aim to reduce those trade deficits, undermine the foundation of that US dollar hegemony? Like, do you agree with Starmer that globalization has failed as an economic model?
It's difficult to unpack. There's a lot in that question. I'm not sure why the UK Prime Minister would say that, but President Trump is convinced that that is the fact. So from the UK's vantage point, I think it's a sort of a silly statement to make. And I don't think globalization has failed as an economic model. I think what has failed is case by case, country by country, redistribution of the gains of globalization. So globalization is the most advanced economic model we have. It works. The question is, how do you redistribute the gains from that model? And so I think the United States has failed in figuring out how domestically, politically, not geopolitically, just politically, to redistribute the gains of globalization to its own people. Is that the fault of China? Is that the fault of the United Kingdom or Canada? I don't think so. Now, in terms of the US as a reserve currency, yes, I do think that you have to have something grease the wheels of globalization. So the dollar and persistent trade deficits are part of that.
Right.
But I would point out several things. First of all, why are we obsessed with goods? Why?
Yeah.
It's pretty arbitrary. What about services, where the US has a massive trade surplus? So it's not clear to me that trade deficits really are what we should hang our hat on, or that reserve currency is something we should hang our hat on. But clearly, I think the Trump administration has identified reserve currency status as somehow an albatross around America's neck. It's a burden. The US is persistently overvalued, they say, which we know for a fact, like mathematical sixth grade math fact, is not true. The US dollar is overvalued right now. So it's kind of a bad time to be having this conversation because the dollar is so expensive and it's definitely hurting American competitiveness. But there have been times when it wasn't that expensive. And there is no evidence that it's persistently overvalued due to its reserve currency status. So I would say that, no, I guess I disagree with every angle of this debate, and I guess we can unpack the disagreement.
Well, absolutely. But for me, it does come down to the US dollar. It's really no good replacement for it. So it's not like people can stop using it, or countries, not people, but countries to stop using the US dollar. At least they're, the BRICS are trying to put a secondary alternative method of currency out there, but it's nowhere near being ready. So the idea is that the US dollar has to remain in its place. So in my mind, Trump almost has great negotiating power because he has the US dollar at his back when he's trying to negotiate these tariffs. Do you agree with that, or would you frame it a different way?
Yeah, I would frame it a different way. If you want to risk reserve currency status as part of negotiations, I think that's very dangerous. There's multiple layers to a reserve currency. One layer is store of wealth in a central bank vault. And Joe Biden already undermined US dollar as a reserve currency on that measure. That's why gold has ripped, even as real yields went up. When inflation came down, gold should have fallen to $800. But after Russia invaded Ukraine, like 1-to-1, gold should have been at $800. But the reason I stayed long gold, in my recommendation for 2 years, is that I told my clients to ignore real yields. And that was contentious in 2023. Like January 2023, saying to somebody you should ignore real yields was kind of insane. But the reason is that Joe Biden did undermine the reserve currency status of the dollar by effectively using geopolitical reasoning to bar Russia's access to its own FX reserves. We all know this. I'm not telling you anything new. But that's only a part of reserve currency. I think the other part, which is stickier, is the provision of liquid assets, such as a treasury, the treasury bond market. It's like there's something where we can all store our wealth in. And the other one is transactions. And those are different from reserve currency in a vault, but they're combined, right? Why would you keep the US dollar in your central bank vault? Well, it's a really good currency. You can go to America, buy all sorts of stuff in America without being bothered by the government, rule of law, all that stuff. There's that reason, but it's also because you use the dollar in transactions. So if Indonesia wants to sell nickel and buy some cotton from Uzbekistan, like what are they going to transact in? And it's the US dollar. So it's a transactional currency as well. And then the final one is financial transactions. So higher speed, not just trade.
Yeah.
Those latter two are much stickier. And what I would say to you is that I think the US is playing with fire if it's using the reserve currency as a bludgeon. And the reason for that is that we've already seen Joe Biden undermine reserve currency in the vaults of central banks. Central banks are clearly diversifying away from the US dollar. There are alternatives to it as a store of value. There just are.
Yeah.
And the second, in terms of transaction, where it's much stickier, United Kingdom pound remained a reserve currency in terms of transactions 50 years after it ceased to be the number one economy in the world. I think technology could undermine that pillar as well. So I wouldn't be messing with the reserve currency status of the US dollar. I just wouldn't be, because you are incentivizing the rest of the world to start thinking on its feet and start looking for those alternatives across those three branches.
Awesome. So let's just take a pause here. So first of all, great to see so many of our Huddle listeners logging in here. Please do type in those questions. We're going to get to them in just a moment. Marko is a great person to pick your brain on in terms of these things. So I'm going to ask you another question here, because you recently described Trump as a human steepener. Okay, and so I got to pick your brain on this. So, how could shifting of the U.S. Fiscal policy influence these yield curve dynamics, and what are the kind of political signals that us traders should be monitoring to capitalize on this potentially steepening further?
Okay, so that's a very important question. And I want to try to wrap it into an answer that's coherent and useful for people listening. I would argue that the trade war and tariffs are not the most important story of 2025. Now, obviously, feel free to throw tomatoes at me, because the S&P 500 is down since Liberation Day quite a bit. And that's cool. It's my hot take. It's my Stephen A. Smith impersonation here. I'm here to tell you that fiscal policy of the United States of America is the most important macro factor, and has been since 2017. Since 2017, the US started with its pro-cyclical fiscal policy. In 2020, during the pandemic, the US went completely nuts. We got an orgy of fiscal. That was a Trump-Pelosi administration thing, if I can call it that. Then Joe Biden took the mantle. So it was bipartisan. But the US spent 4 times more than Europe, as an example, in terms of fiscal thrust. So when you're sitting there and thinking about big tech, Mag 7, US exceptionalism, US dollar, to me, it's all one trade, and its fiscal thrust in the US just went absolutely insane. And the dollar didn't peak with April 2nd. Big tech and Mag 7 didn't start selling off on April 2nd. I actually agree a little bit with Treasury Secretary Scott Bessent, who's been made fun of out there, which I think is unfair when he blamed DeepSeek. Yeah, yes, there is some of that. But the reality is that the market started realizing that the US had reached the end of its fiscal thrust. We started seeing that in December and January and February, where basically President Trump gets elected, bond yields jump 100 basis points. Remember that? We went up 100 basis points as the Fed was cutting 100 basis points. That hadn't happened since the 80s. There's been 45 years that this has never happened. Bonds sold off. We reached 4.8% in the 10-year. And the House of Representatives panicked. And I would argue the White House panicked too. That's why Bessent is the Treasury Secretary and not Lutnick. And it's also why Doge exists, because the Trump administration has realized that they're basically at the end of ability to cut taxes further and widen the U.S. deficit beyond the extension of the 2017 tax cuts, which is going to happen, by the way, and the bond market will swallow that. But they can't really engage the fiscal side anymore. We're at the end of that. Now, why does that matter for the trade war? Where it matters, because if you're trying to trade the trade war, you have to understand something. The United States of America is pointing a revolver that has no bullets in its chambers. They're out of it. They're at the end of their fiscal gravy train. The rest of the world is not. So you can't just extrapolate the impact of the trade war and say, well, US doesn't trade. Exports are percent of GDP is like 8%. Europe and China, they're screwed. No, because policymakers react to the macro reality. And the way the Chinese, European, Canadian policymakers are going to react, they're going to say like, well, guess what? We have fiscal space. So we will stimulate. Oh, and by the way, if you want to have a trade war with us, we'll make sure that stimulus doesn't trickle down to the US. Especially because, one of the problems US has is that it tends to export capex goods, defense goods, aerospace goods. A lot of procurers of those goods tend to be either state-owned enterprises or SOE adjacent entities. So like I can see how no airline on the planet is going to buy a Boeing aircraft over the next 3 months. It might actually cancel those orders. So this is where fiscal policy in the US coming to its end is critical. It showed up in the dollar and performance of US assets well before Liberation Day. So from January onwards, the rest of the world was kicking US ass in terms of asset performance. And now that the trade war has been initiated, the second order effect is that the rest of the world is actually going to grow faster than the US. And this is not at all what most sophisticated investors on the planet thought 12 months ago, where there was a very clear one-way street. Trump gets to be a president. He starts a trade war. I want to own dollars, and I want to own American assets because they're safe, right? America is insulated. Well, no, America is not insulated because its economy has basically been riding on the hog of fiscal policy.
Okay. So from a steepening perspective on the yields, are you looking at it from a combination of a bull and a bear steepener where like Powell's going to obviously there's recession risks here. So how the SOFR futures are pricing in lower rates on the front. But is it also a bear steepener where you think that the long bonds are going to be continuing to rise in yields? Like how would you kind of play it in terms of the steepening?
So I think, first of all, I think it's very dangerous to extrapolate the rise in yields over the last couple of days. That does sometimes happen at the height of liquidation events. It could just be people liquidating assets, including US bonds, to deal with margin calls. So just to be very clear, this may not be a sign of some sort of a structural shift. But for the sake of a live stream podcast, let me take the other side of that bet.
Okay.
And so I think, so in other words, you can explain why yields went from 3.9, 4.2 with just like, well, there's a liquidation event. People want to liquidate everything. Asian markets are collapsing. Asian investors are selling US treasuries to deal with their own margin calls and so on. But I do think there's a problem. If you look at what happened in 2023 with Silicon Valley Bank, We had an
Right.
incident, a financial crisis incident. Many bears said, here it is, here's a recession, here's the GFC. What happened? Yields went down to 3.25. 2024, we had the Somme rule event. Many thought, here we go, here's the recession, labor market slowing down, this is it. Yields went down to 350. And here we now have an epic trade war of like monstrous proportions with President Trump dousing himself in gasoline, lighting a fire. Oh my God. And what happens to yields? They actually go from 4.5 to 4.2. The April 2nd announcement, we went from 4.2 for 4.2. You might say, well, no, we went from 4.8 to 4.2. No. Bonds rallied from 4.8 because the bond market realized President Trump wouldn't get his fiscal policy through, like to the extent he wanted. That wasn't a recessionary bond bullish move. So I would take the other side and I would say, no, something is happening. I'm going to be a little bit more profound than just, oh, it's a liquidation event. I think that the 10-year yield should come down in a recession. I'm not a zealot. I don't think we're going to be at 5.5 as the recession is happening, but they may not come down as much. And that's a problem. And that's a big problem for Scott Bessent and for the White House, because one of the things they're trying to do is get the 10-year down. Why? Because we all know why. We all know. American households are healthy. They've never been healthier.
Yeah.
Like wealth relative to debt, I mean, we haven't had that since the 70s. So if you get the 10-year yield down to 2.5%, I mean, it's going to be a bonanza of durable goods sales, of real estate purchases. It's going to be an epic bonanza. The problem is that we all know that. We all know that. So why would yields go down to that level? You know, like, what are you going to own bonds for like 6 months and then and sell them, or for 6 weeks or 6 days? And on top of that, the recession is happening because the United States of America decided to start a trade war with everyone else. And I believe that the White House is religiously watching the 10-year yield. I thought that before Secretary Bessent said he is. And I think that they should be extremely uncomfortable with what's going on right now, because if all of this is designed to somehow spur growth domestically through lower borrowing costs, well, guess what? You just fired all your bullets and the borrowing costs are higher than they were in two last recessionary mini events. It's not a good thing. So where do I think it goes from here? Again, just to say, I don't think the 10-year yield can go up in a recession, but I think that it will not go down as much as policymakers in the US wanted. So it's a worst outcome from a real economic performance.
All right. Well, we're going to get to the questions here. By the way, again, all of our listeners that have just logged in, please type in your questions. We're going to get to them right here in a moment. But Marko, I just wanted to ask you one last question, because we can't I don't want to stream off this topic without first talking about the tariffs, and particularly China. In light of this escalation with the U.S. imposing this 34% tariff on Chinese goods, and obviously China now retaliating with equivalent measures, how do you assess China's strategic options, like in this conflict? How does this play out?
Again, I think that most people in North America, in particular in the US, are just overestimating the chest beating of the White House. This notion, you see it on Twitter, you see it in just commentary, you see it in official statements. US is the largest consumer in the world, largest economy, of which 70% is consumption. The rest of the world just has to do whatever the US says. Maybe. In 2018, that was relatively the case. There was no fiscal space. Politically, there was no fiscal space. Nobody wanted to break with the austerity fetish. We're well beyond that. The rest of the world is going to use this as an opportunity to do all sorts of dirty work, difficult work that they couldn't do in the past. In a way, Donald Trump is, I've been joking, it's this analogy to that spoonful of that fishy, smelly oil you used to feed children to become stronger. That's what Donald Trump is. He's a spoonful of medicine that you give to children to boost their immune system every day. He's making the world a great place. And I think that China is going to do the same. I think China's looking at the situation and they're kind of done. They're like, look, every 4 years we have a new guy in the White House, new export controls. Let's just rip the Band-Aid and do two things. Number one, they're in a political bind, the Chinese. they've been telling their citizens, the corporates, that they're not going to stimulate, that that's a mistake, that the West is making a tragic mistake by spending too much money. And the truth is the only way to get out of a private sector deleveraging moment is to stimulate the government. Like, that is it. This is a solved mathematical problem.
Yeah.
Yanis Varoufakis, Richard Koo, they've all told us how to get out of a private sector deleveraging. You need to boost GDP so the debt to GDP goes down. Duh. That's like done. They haven't done that. And so here comes big bad Trump, and he starts being mean to you. And what do you see from China? They're already finally communicating, not yet numbers. There's no numbers associated, but they're finally starting to communicate. We need to start doing something in terms of consumption. Boom, done. Thank you, President Trump. The second thing is that they're going to use this as an opportunity to find new markets, to make new trade deals. And this is the part of this that worries me from America's perspective. There's this assumption that the rest of the world just owes America for its sweet taste of liberty. Very, very bad assumption. The rest of the world is not engaging in a trade war against the rest of the world. You have EU and China meeting a couple of days ago. You have EU and India meeting. You have things happening. China and India have been resolving their border dispute for the past 6 months. No one's even paying attention to that. And so the biggest risk here is that China uses this as that kind of 6 months of difficult, painful work to rotate out of dependency on American consumer.
Right. All right. Let's get to some of these questions. Danny, hop on here, buddy. By the way, we have to comment on Marko's amazing mic. Like, that's a huge mic you have there, buddy. It's you started your own podcast, right? What's it all about?
Yeah, it's called Geopolitical Cousins. It's with my good friend Jacob Shapiro. We're cousins basically from like, it's a joke. We're not actually cousins, but he has the smoothest voice in our business, honestly. And so, yeah, he made me buy this giant mic that tries to make my voice smooth too, but I don't think it's really going to work. But that's a podcast really designed for like your uncle. Like, if you have that guy in your family, you should listen to our podcast, because it's going to give like reasonable explanations for what's going on in the world. It's not actually meant for investors. I work at BCA Research. I sell my research. I sell my market calls. So it's not like you're going to be able to listen to this podcast and make money off of it, but you're going to be able to listen to this podcast and be the life of a party. You're going to be able to, use.
And I'm going to listen for sure then. No.
Well, exactly. I think that's what I'm going. Like, I want my mom to listen. She can't read my research. She's like, what is this nonsense? But she can listen to this podcast. So that's who it's designed for. My buddies.
Where do they find it? It's on Spotify?
It's everywhere, like iTunes, Spotify. It's just called Geopolitical Cousins, and our logo is those two old guys from the Muppets. Because just to be clear, we're going to be Muppets on this show. Don't take it too seriously.
All right. Well, that's awesome. Well, I'm looking forward. I'll have a listen. All right, Danny, let's fire up some of these questions. What's the first one we want to address?
So this one's from Gia. He says, what measures can the US take if over time countries increasingly adopt the euro as a means of settlement?
I think, what can the US do to reverse that? I mean, nothing. That's the problem. You don't want other countries to start finding reasons to adopt other currencies as a tool of settlement. And I think that this is something to understand about the US dollar. Like, reserve currencies become reserve currencies. Yes, there is a geopolitical military component to it. Absolutely. Absolutely. But let's not overstate that. There is also a very important component, which is just the ability, like knowing that you can, with a piece of currency, go and buy something, and that's not going to be expropriated or taxed, or that it's just going to disappear. Right. So there is a whole notion behind reserve currency. Like, this is why I think it's going to be very difficult for China, because I can't just go to Hainan Island and buy myself a beachfront townhome and then sell it willy-nilly whenever I want. Like, this is a difficult process. And so I think that when you have members of the White House, like Stephen Miron, who I respect immensely, and he's written some very interesting stuff, but when they say, look, the reserve currency is a burden, and oh, by the way, we might have to start taxing financial flows. Yeah, you're going to encourage the world to go to the euro. Absolutely. You're going to encourage the world to go to Brazilian real, quite frankly, at that point. You got to be very, very careful, because you're like, forget aircraft carriers, forget javelins, forget this, that, or the other. Like, who cares? At the end of the day, I don't want to transact in a tool that's going to have expropriation or taxation on it in an onerous way, because then why would I use it?
Yeah.
Why would I have it stuck in my checking account? I'll go and I'll find something else. So if they want to reverse, if they want to ensure that there is no alternative to the US dollar, then I think that the most important thing is to reassert this notion that the US has had since it's really existed, which is that once you come into the country, you can buy whatever you want, you can sell it, you can use it as a store of value. It's a safe currency based on an application of rules in an arbitrary way. So when you use ChatGPT to determine tariffs, the problem is that you're undermining that idea. And so if you're and I'm not saying this because like Marko Papic thinks so, my clients think so. CIOs of sovereign wealth funds and pension funds that I speak to are not happy with what just happened. Not because they're going to get tariffed, they don't care. It's because if you can pick tariffs based on sixth grade math, you might want to institute, Tobin tax, which is a tax on small tax on financial transactions. And it's small now, and God bless Republicans, they love small taxes, right? Beautiful. But let me tell you, 4 years or 8 years from now, when AOC is the president, she may increase the tax. And it was Donald Trump's fault for even instituting that lever onto the dashboard of American politics. You see, so that's where I think the arbitrary nature of some of the application of rules towards global investors and global trade partners has a definite detrimental impact on US as a reserve currency. It's not really what anyone else has done out there. I laugh at the notion that the BRICS can create a reserve currency, but can the US destroy it? Yes, they can.
All right. Well, there's a question here from Christian, and he was asking, under what conditions should we start considering the conversion out of US dollars to maintain the relative value of profits made within the US financial markets? And what currencies might you be considering diversifying to?
A couple of things I want to say. I think that reserve currency is such a incredible, exorbitant privilege of the US that all the risks and threats we're talking about right now are not going to be articulated. Donald Trump, despite what the media says, is not an idiot. And so I don't think that they're going to risk reserve currency status. So I just want to say that. That's a high conviction view.
Yeah.
It is so stupid to risk reserve currency status that it's not going to happen. Number one. Number two, to answer that question, I don't think, I've been telling my clients to get out of US assets for 12 months now. This is my main view. My main view is not what's going to happen in the trade war. I kind of don't care. My main view is not what's going to happen with Donald Trump, this or that. I think if Vice President Harris wins the election or President Trump wins the election, same outcome. The US economy has been riding on the hog orgy of fiscal stimulus for the past 6 years.
Right.
That's ending. US assets are going to underperform, including the dollar. And this is an important caveat before I answer this question. I hate it when you say something like, I think the US dollar is going to decline 30% over the next 2 years. And people counter by like, so you think it's going to lose reserve currency status? No, I don't. Yeah. US dollar is a financial asset. It goes up and it goes down on occasion. Like in the early 2000s, from 2001 to 2007, what did the US dollar do? It went down.
50%, almost 50%.
50%. Thank you. And by the way, did the US lose hegemony? Hell no.
Absolutely not.
George W. Bush was throwing darts on a map and choosing which country to invade based on where the dart landed. Let's not joke ourselves. The US was as powerful as any country in the history of mankind from 2001 to 2007. Facts. And yet the dollar lost 50% of value, as you say. So this is an important point. I can be a dollar bear without some geopolitical mumbo jumbo, just to be clear. And I am. I'm a dollar bear. So to answer your question, hell yes, you should be getting out of US and US assets. Now, the reason I say that is because everyone listening to this live stream is probably 80% in US dollar assets. I'm not saying to go down to zero. That would be insanity, of course.
Yeah.
the way I've put it to my clients over the last 12 months is take like the top, skim from the top of what you made in Mag 7 and Tech Bros who are all lying to us. Take whatever you can from that, skim it, and go shopping around the world because the world is cheap. And I think that's the big message of what's going on. And on some level, I think Harris would have led us to the same event. This isn't all Donald Trump's fault. I just think that he will accelerate the process by which this is happening. And when history is written, when history books are written 50 years from now, he will be blamed for the decline of US assets. But quite frankly, I think it would have happened anyways.
I agree with that statement. It was at ridiculous levels. Now the question though was where would you diversify to? Now I know that you hold a bullish stance on European markets. Obviously, there was a liquidity event. The U.S. The European markets dropped 20%, just like every other global market. But you clearly had a bullish stance. Is that still the case? Like, do you have this bigger macro position still bullish Europe?
Absolutely. If you look at performance of assets from January to Liberation Day, that is the truth. So go back January to April 2nd. To me, that's the truth. And that will be articulated over the next 5 years. And what I mean by that is Europe was, China was the main outperformer. And if you want to, high risk, high reward, I think that there will be more volatility in Chinese assets, but I'm not bearish on China. I think China will also outperform US over the next 5 years. The problems there is not everyone can trade China. I think it's difficult. What are you buying? So I'm going to go with a big, liquid, easy to trade assets. And I think Europe will be the best performer over the next 5 years. It has a lot of things going for it. No, it's not just the fiscal policy in Germany. I hate that narrative because it's kind of made it so obvious. It's not just defense stocks. To me, Europe has a couple advantages we never talk about. One of them is that they make capex goods. It's not cars, it's machines and machine tools. They do that very well. And we are in a capex, we're in a global capex cycle because we're trying to do too many things at the same time. We're trying to de-risk from climate change, fossil fuels, Russia, China, now America. You're just going to need to build a lot of stuff. Europeans build a lot of stuff. And then the second one, which is much more controversial, but easier to explain, there's a tsunami wave of LNG that will absolutely drown Europe in cheap gas over the next 2 years. So you've got about 6 months left to deploy assets into European industrials because the notion that Europe will deindustrialize was one of the most lucrative, idiotic ideas in the financial community we've ever had. And you want to invest in idiotic ideas, right? So that was an idiotic narrative that Europe will deindustrialize. Second World War did not deindustrialize Germany, guys. Like, you know what I mean? Like, it's not going to happen. And the cure to high energy prices are high energy prices.
Yeah.
And that's happening. So those are some things that a lot of listeners here haven't heard before. Everyone knows about Germans now spending money, defense. Okay, cool. But there's structural reforms happening in Europe in a really smart way. And then there's these other two things that I would say. Europe is built for the future. America is built for a very, very calm, beautiful world where no one's fighting and everybody needs an app so they can get a date at midnight and then a cheeseburger at 3 a.m. when he or she leaves. You know what I mean? That's what American stock market is geared towards. It's a world of peace, prosperity, and platform app companies. Europe is actually really good at a world that's beset with capex intentions and capex needs of a restructuring supply chains, energy grids, and train planes and automobiles. That's what Europe is good at.
Do you also think that it's inevitable that the Russian gas starts flowing again as de-escalation may come? Like, is that going to be a boost for Europe inevitably if that happens?
I'm open to it. I think that in 12 months it's not going to matter because there's going to be that much LNG. I mean, we're talking about an absolute deluge of LNG supply. Qatar, British Columbia, Mozambique, United States of America, and Russia itself all made kind of a mistake trying to replicate what Australia did. There's just too much coming online. And by the way, your point about Russian gas, I mean, here's the truth. Russian natural gas that goes to Europe is produced in the Yamal Peninsula, which is in the European Arctic. You cannot build a pipeline to China. Every 6 months you hear something about it. It's just not going to happen. And so the Russians, they're just going to build LNG facilities to get it out of there. These are ice-breaking LNG ships, very expensive. They're going to have to do this because, and then they're going to just compound the supply glut. And I bet you anything, most of those LNG cargoes end up in Europe. But because it's not piped, somehow it's okay from a European political correctness perspective. I mean, like,
yeah,
I love my job.
There you go. All right, Danny, jump on here. What's the next question?
So I think there was a few people asking about gold. So I guess it's just kind of like, just instead of me asking the question, just a general outlook next 6 months and long term. I think some people are kind of asking your view on that.
So I was it was my premier investment recommendation, I think, from January 23, and then I closed in December of 25, and then I reopened it in, I think, February again. I thought, hey, this has gone on a little bit too high. It's been flat since I reopened it. I missed some of the gains in that January, February kind of run up. Right. I just think that what's working against gold is that the fiscal policy in the US will not go back to its profligate years. And I think also what's working against gold is that President Trump could, on a dime, declare victory and take in the deals that are coming in right now. So there's a lot of deals on the table, 0% interest rates, 0% tariffs, like Europe offered 0% tariffs. Hey, we'll buy all the natural gas that you pump out, which is kind of a stupid thing. Why would anybody say no to US commodities, But President Trump, it's in no way a benefit to the US. There's going to be an announcement. Europe commits to buying $200 billion of natural gas from America. And people are going to applaud. And it's like, well, what do you think is going to happen to natural gas that's put on cargoes? It's not going to not be bought, but whatever. My point is, he could easily declare victory at any point, and look like a genius, even though people who do the math will then be like, well, it's positive, but it's not like transformative. I think those are all negatives for gold. Like if we pivot out of extreme tariffs, no more inflationary impulse, some of those long-term inflation expectations might come down, which means long-term real yields go up. Less fiscal policy in the US, that's bearish gold. However, I just think there's enough momentum in terms of central bank diversification, which has probably accelerated due to Trump's policies, that I do think that gold is going to continue to hold the line that it's just established of 3,000. So I don't think there's a much downside risk to gold. I just think there's less upside potential than there was in the last 2.5 years. Yeah. So I'm not bearish on gold. I still have an open recommendation, but I'm not as excited about it as I was last 2 years.
All right. Now let's talk. There's a couple questions about Canada, so let's just dive into this. Now, you lived in Canada for a while. Now you're south of the border, so you have some skin in the game in terms of a kind of outlook of what's happening. Obviously, Canadians have taken it very personally in regards to the direction that Trump has been going with on all of this, and there's like this talk of Canada having to diversify away from the U.S. And now, obviously, there's tensions between the U.S. and China. And how does Canada navigate its economic dependence on the U.S.? Or does this whole tariff thing just blow over after a while and Trump declares victory and things will be back to normal in a year? Or is there started a chain reaction where Canada is now going to go in a different direction? And if they did turn to more trade with China and other things like this, how does it stress the relationship between the U.S. and Canada on that front?
Yeah, thank you. So first of all, I'm Milan Lucic of Geopolitics, I would say, just to be clear. So I am Canadian, of Serbian origin, if you will. And so, but I'm also bathed in aloof indifference when I do my job. So I'm going to give you, a non-biased perspective on Canada. And so I think that Canada made a huge mistake over the last, I don't want to blame the Trudeau administration because everybody does, I think it's a multi-decade mistake. And that mistake is in not diversifying. Canada is a milkshake with one straw in it. And it has only itself to blame for that. It's not America's fault. Hey, I mean, this is extremely lucrative to the United States of America that it has the only straw into Canada. It's Canada's fault. And not just Trudeau. Why wasn't this built? Like, pipelines are not 21st century technology. Like, why weren't there pipelines built to the Atlantic and the Pacific much, much earlier? And we know the reasons why. There's environmentalism, there's different governments, there's lack of expenditure in CapEx, which I think is one of the main mistakes that Canada has made over the last 30 years, but maybe 200 years. So I think that I actually think President Trump could walk out of this looking pretty good. I really do. I know a lot of people are going to be angry about this. The market is collapsing and so on. And no, it's not because he's going to return manufacturing jobs to the US. That's a ludicrous notion. It's going to be robots. So have fun with that. No, it's because he will get deals. He'll get a deal with Canada. He'll get a deal with Europe. He'll get some FDI. He'll get some factories to be built. Like, he can walk out of this with deal making for sure. But where he did make a critical error is in using some of this rhetoric, which is like a little too far. Why? Because it may be that it's a joke to Americans. And by the way, Democrats have made this joke as well. Politely, perhaps, but they've made this joke. Liberals make the same joke. Canada's a 51st state. But when you do that, while it may be a joke to you, a Canadian leader has to assume some probability of that happening over the next 50 years and therefore start hedging. And it's just like, why would you want to incentivize Canada to hedge against the US? Why? Through its long term. It's just an own goal. And again, like 6 months from now, I do think the trade war is over. I don't think we have reshaped global trade in a significant way. I think maybe the 10% tariff stays, and then is removed by the next administration. Like, I don't think the world is going to be massively different. I think President Trump walks away, as he has always walked away, with a marginally positive deal for America. But why why sow these seeds of doubt around the world that cause rebalancing effects? And so, yes, I do think that Canada is now clearly committed to that rebalancing, and it's going to, at the very least, build more straws in its milkshake. That's not optimal policy for the US. The second thing is, can Canada diversify? Well, one of the things that I think is very interesting, for 150 years of Canada's existence, it never solved the most simplest issue, which is intra-provincial trade. This is like one of the few countries on the planet that it has a federal construct, and its federal entities don't have free trade with one another. Many of the listeners don't even know this because it's so hilarious and so idiotic. And yet we're not going to solve it in like 3 to 6 months in Canada. And it's like, again, that goes to my notion that President Trump is that spoonful of really stinky, bad tasting medicine nobody wants to have, but now everybody is having it. And I mean, again, God bless President Trump. Yeah. He's solving problems for everyone everywhere. And he's now incentivizing Canadian government and provinces to sit down and be like, wait, time out. How much can we lift GDP by having smooth intra-provincial trade? Wow. And again, like that is an interesting, I think, outcome of this. I do think that Canada is going to come out of this much stronger. That's what I would say. And as every country will. And this is the fallacy that's right now taking root in the White House, is that they can just do whatever they want. There's second and third order of effects. When America goes from being magnanimous to Machiavellian, there will be second and third order effects that will not be beneficial to the US in the very long term.
All right, fair enough. There was also one question online about the Bank of Canada selling US denominated federal debt Do you have any comments on that or any opinions?
No, so that's a little bit too much in monetary policy plumbing. I don't think that's nefarious or insidious.
Yeah.
So that's what I would say. I don't really have a comment on that. But you have seen, for example, Canada come out and say that they're going to reconsider the F-35 deal. You know, there's other ways that Canada's signaling, like, hey, we're not a 51st state. We can buy the French Rafales. Actually, if I was running Canada, I would have just bought Swedish Gripens. It's perfect, actually, for Canada's territories. It has a very short runway ability. It can land anywhere for a fighter jet.
Yeah.
You know, and this is something that Americans really have to kind of consider. I don't understand why the White House is favoring a theoretical assembly line worker in Ohio, like a theoretical one that will appear out of nowhere in the next 5 years, instead of favoring the real assembly line worker in Seattle and in Washington State. And that goes back to my point. The way that countries will retaliate against the US is not necessarily against tariffs. They'll do that through capex goods and defense contracts. And, you know, there are many alternatives to American weapons. American weapons tend to be designed to fight a thermonuclear war with like a nuclear power. Most countries are not going to go to war with China. You know, like Brazil doesn't need F-35s. It's got to deal with Venezuela, and they're like 12 Suhois. So most countries don't need to fight aliens with expensive American technology. There's plenty of alternatives out there. And so I think what Donald Trump is threatening right now is actual blue-collar jobs across America that actually exist today. And that's, I think, something that's happening in the White House in the conversations with members of the Republican Party from these states, you know, whether it's agricultural states, which are conservative, which got a lot of farmers depending. Like, when was the last time you ate a pear? Well, guess what? Americans produce pears and they send them to China because Chinese are obsessed with pears. So there you go. And similarly, like Boeing is already on the last leg. Why would you kick it down even further through this kind of policy? So, and that's where I think the constraints are going to start tightening on the administration. And I think they will look for an exit. Now, just to be very clear, there's a lot of traders, a lot of day traders watching your show. I know you guys are like, you know, really like top in that community. I would just be very cautious. President Trump can remain, you know, aloof longer than you can stay liquid. Like, he can ignore these material constraints. So I would not be bottom fishing right now just because Marko Papic thinks eventually this is going to be a negotiation. In fact, if he is a good negotiator, it is in his interest to convince everyone he's a neo-McKinleyist. You know, he believes that you can finance the whole government through tariffs. It's in his interest to project as a neo-McKinleyist in order to get the best deal that he can get. So just keep that in mind. I do think 12 months from now, we look back and say, wait, that was it? Like, you know, but it doesn't mean that these next 12 weeks can't be up and down pretty viciously. So I would trade using technical indicators right now. This is a trader's market. This isn't like Marko Papic market, you know?
Yeah. Okay. Danny, hop on here. What's any other questions that we should address?
I think, to be honest, you've covered most of it. I think a lot of people are asking about, like, what's the end game with China? You know, a lot of it seems to be like, you know, what if Xi doesn't come to the negotiation table? It's more like, I think it's the uncertainty with China that most people are kind of focusing on.
Yeah, that's fair. There's a lot of that. I mean, I'll say a couple of things. Over the last 5 years, I've heard a lot of China hawks, like former members of the administration. You know, you go to like a dinner or an event, and somebody who was in the Biden or a Trump White House comes out and says, like, China's going to invade Taiwan over the next 12 months because there's a whole cottage industry in the private sector of these ex-national security people running advisory firms. And their number one priority is to show up in your boardroom and scare the shit out of everyone. And the way to do it is they say China has a window to invade in 12 months. One of my favorite was there's a senior person in the first Trump administration who had this view: China will invade Taiwan in 12 months because the javelin stockpile has run out. Like, that was like, we used up all our javelins in Ukraine. I was like, you're not, like, Chinese are not going to invade Taiwan with tanks, so why would you use javelins anyways? But, you know, whatever. So my point is this: I'm going to use one of those. If China doesn't militarily reunify with its wayward province of Taiwan in the next 12 months, like he never will, this is a perfect window of opportunity, right? If you're Xi and you have to justify doing something pretty dramatic, President Trump has given you that excuse on a silver platter. Like, the Americans are mean to us. They're very, very mean. They don't want us to grow. Therefore, YOLO, right? Like, this is it.
Yeah.
So that's one thing I want to just say to everyone here. Like, to me, I mean, I'm being hyperbolic, obviously. You never want to say never, but like, next 12 months, here you go. Here you go. Perfect excuse domestically for why you got to do something that will be unpopular in the global sort of marketplace of other countries. That's the first thing I would say. The second thing I would say is I don't think there is really an end game to US-China rivalry, you know? And I don't think it's complete bifurcation. Because one of the problems for the US is that it cannot use tariffs as a bludgeon and then not remove them completely. So if the whole point right now is to incentivize the rest of the world to say no to China, you cannot use sticks for that, because it's a multipolar world. And many think that when I say it's a multipolar world, which I've been saying for the last 14 years, people think that I'm saying America's not a great power. It is. It's the most powerful country in the world. It's head and shoulder above everyone else. But to have the status of a hegemon, you need to be head, shoulder, torso, hips above everyone else. So just being the most powerful, it doesn't mean you're the only one. Like, there's still other bullies in the neighborhood, and they got their own little corner. And so it's just going to be impossible for the US to truly incentivize the rest of the world to completely abandon China. And then if US abandons China unilaterally, it puts itself at a disadvantage. I'll give you a specific example.
Okay.
Boeing versus Airbus, right? If France does not join America in its crusade against China and continues to sell Airbuses to a growing market, i.e. China, then Boeing is going to lose considerable amount of revenue, and therefore its R&D efforts are going to fall short, and it's going to be less capable of designing fancy technology with which to one day kill Chinese in a theoretical future war. And this sounds very silly, but this is exactly what game theoretical work by political scientists from the 1990s proves. There's a wealth of academic research on this. You see, in the 1990s, when Cold War ended, many academics thought we were back in a multipolar world. They were actually wrong. We went from a bipolar world to a unipolar world. America was the hegemon. Nonetheless, they kind of did all the work for us in the 90s. Plenty of work out there. And it shows that a multipolar world actually retains globalization at a pretty high level, not as high as when there's one country in charge, for sure. There's sand in the gears, as we're seeing now, but it's very difficult for the US to abandon trading with the enemy, which was the case in the 19th century. Enemies traded with one another because it was very difficult to unilaterally say, we will swear off of the Chinese market, because all your friends and allies say, well, we won't.
Yeah.
You know? And so what I would say is the end game is the status quo. The US and China continue to not like each other, but in some sectors and in some ways, they continue to interact. Yes, you know, so less high tech, less chips, less this for sure. The US continues to put up trade barriers on some of these technology, and they continue to fail. Like DeepSeek proved, like China continues, technology will keep seeping through the cracks and crevices into China. And this is just the world that we're living. And in that world, the worst thing that the US can do is, like an ostrich, put its hand in the sand and put up trade barriers with the rest of the world, because it will then impair its own ability to compete and innovate.
Yeah. All right. So I want to hit you up with one more topic, because I want to make sure that the interview is far more complete, or at least this live session. I wanted to talk about emerging markets. There's obviously growing geopolitical fragmentation. Which of these emerging markets do you see strategically positioned to outperform, and which ones alternatively may suffer because of the way that things are shaping?
You know, emerging markets are so unloved. I just know from speaking to institutional investors, like right now on the planet, there's only 2 emerging market dedicated macro hedge funds, only 2.
Wow.
And what I'm seeing from the allocator community, particularly, of course, one of the best communities, Canadian pension fund community, but also broader than that, sovereign wealth fund community, there is an increasing appetite to diversify out of the US because of everything that we've been talking about today. And so emerging markets are starting to pick up demand, but there's no supply. There's not enough asset managers managing basically emerging markets. And so anyone who's listening to this, who's actually an asset manager, who actually has a fund, try to start, this is a business development point. This is not me trying to pitch you on buying emerging markets. It's me trying to pitch you this idea that you should start thinking of how to position yourself as this demand grows.
Right.
What should you own in emerging markets? First and foremost, I would just say everything. If you are just a retail investor listening to this, you're just like trying to manage your retirement, don't try to make like, oh, I'm going to go all in on Malaysia. Why? Because the kind of assets we as just normal human beings can own are oftentimes like banks, like, and so you're not owning actually anything cool in many of these countries. So that's the first thing. The second thing is if you want to refine your view a little bit, it comes down to what you think about commodities.
Sure.
If the future is commodity friendly, which I think it is, then you want to own Latin America, you want to own Middle East. I think you want to own some of the other Southeast Asian, some of their markets like Indonesia could be an interesting commodity play as well. But if it's not about commodities, then you want to own China, India, Eastern Europe. If it's about supply chain, and Southeast Asia as well, like Malaysia, for example, would be an interesting supply chain story as well. I have a bias towards being a commodity bull long-term, but I'm open to that being wrong. And so what I would say, again, to retail investors is like, just deploy into an emerging market, just fund, let somebody else manage this for you. I know that sounds like a bad advice, but remember, trading by yourself in these markets I think is very dangerous because oftentimes you'll be buying things that have no real, sort of access to a broader theme. It's just like Malaysian banks. And I'm not sure that that's really that interesting. It could be that, Malaysian credit cycle is just not in your favor. And then you lose out even though Malaysia does well geopolitically and economically.
All right. Well, listen, actually quickly on the emerging markets, you didn't mention Mexico. Obviously, Mexico had a bit of a bear market in the last year, kind of declining stock markets, their own politics in play. Obviously a target of the tariffs as well. We talked about Canada. Do you have a different view on how things play out in Mexico?
No, I am also bullish on Mexico in the long term. I think that they will figure things out and they will continue to be very highly integrated into the US. Under Trump, there is this notion that North America and Western Hemisphere, this kind of rebirth of the Monroe Doctrine, you can't really do that without Mexico. They may have to sacrifice inward investment out of China as part of this. Yeah. That's what the White House is pushing. And it's fine. If I was running Mexico, I would say that's a fair deal. US, we are pretty close to you. I think the irony will be, this is a kind of a right tail risk for Chinese markets. I think the irony will be when President Trump forbids inward FDI out of China into Mexico and then allows it in the US. And instead of BYD building a factory in Mexico, it ends up building it in Ohio and doing a JV with GM and transferring EV technology to the Americans. That's the kind of a deal I can see President Trump getting, which will be hilarious because he will have stolen from poor Mexico Chinese FDI. But yeah, I think that I'm not bearish in Mexico, in a sort of an EM story. But again, for investors on this call, I think trying to pick one country over another would be probably a mistake. I think just deploying your hard-earned US dollars that we all have, whether Canadian or American, we're all full of them, start deploying them in just non-US assets. And I would kind of use a machine gun approach. It's perfectly appropriate. It's not embarrassing. It's not a cop-out. It just is what it is. A little bit of Europe, a little bit of EM, a little bit of Japan, without necessarily putting a high conviction call on any particular one.
All right. Marko, Thank you so much, buddy, for joining us. So listen, before we let you go, just give yourself a shameless plug, the podcast, where people can find you, everything.
So again, I think the podcast is probably the best and most entertaining version. But if you are an institutional investor and want to go the B2B route, as we say, obviously you should go to BCA Research, and you can get the research, which is pretty in depth and definitely not for my mom. But if you just want to like spend some time while you're commuting, or while you're working out, listening to me going hyperbolic, and it's really entertainment. Geopolitical Cousins is the way to do it.
Awesome. Well, listen, I'm going to definitely have a listen to that podcast, and what we'll have to do is coordinate a time to do a live Market Huddle session in Toronto, where we all somehow meet up there all at the same time. And
I would love that.
And it'll be a great time. But thank you so much for joining us. It was great to chat with you, and I'm sure all of our listeners really enjoyed it. So thank you so much, buddy.
Absolutely. Thank you for the platform. Really appreciate it.
All right. Cheers.